Ozco borrows $100 million from a foreign associate, BetaCo, at an interest rate of 12%. BetaCo sourced the funds from a $100 million loan from its parent, AlphaCo, paying an arm's length rate of 5%. BetaCo and AlphaCo are residents of countries with significantly lower corporate tax rates. BetaCo performs no other role in relation to the loan arrangements, and there is no commercial reason why Ozco couldn't borrow directly from AlphaCo. The alternative postulate would be that Ozco would have borrowed the $100 million directly from AlphaCo. The tax benefit is the 7% differential in interest rates between the deduction claimed under the scheme and the deduction that would have been available under the reasonable alternative postulate. Diverted profits tax is imposed at a penalty rate of 40% on the $7 million DPT tax benefit, resulting in a DPT liability of $2.8 million. Part 4A of the ITAA 36 contains two sets of provisions aimed at limiting multinational tax avoidance. The Multinational Anti-Avoidance Law applies to multinational organisations that attempt to reduce or avoid Australian tax liabilities through artificial arrangements. The MAAL provisions firstly require a scheme where a foreign entity makes a supply to an Australian customer with relevant activities undertaken in Australia and by an associated Australian entity, with the foreign entity deriving income from the supply but not attributing that income to an Australian permanent establishment. The next element is whether the foreign entity carried out the scheme with a principal purpose of obtaining a tax benefit and/or reducing a foreign tax liability. This principal purpose test replaces the dominant purpose test that generally applies to the Part 4A provisions. It establishes a lower threshold and refers to the main purpose or one of the main purposes to the scheme. The final element is whether the foreign entity was a significant global entity, being large multinationals that have annual global income of at least $1 billion and would have obtained a tax benefit or reduced a foreign tax liability under the scheme. If the MAAL provisions are satisfied, the Commissioner would likely argue that if not for the scheme, the supplies to Australian customers would have been through an Australian permanent establishment of the foreign entity. The tax benefit from the scheme would likely be cancelled and an arm's length amount of Australian assessable income would be attributed to the entity, leading to an Australian tax liability. Further, a withholding tax liability may be imposed where the foreign entity's permanent establishment would otherwise pay interest or royalties to a foreign resident. The diverted profit tax applies to multinational organisations that divert profits away from Australia to low tax jurisdictions through artificial arrangements. The DPT provisions firstly relate to tax benefits. Where the taxpayer obtained a tax benefit in connection with a scheme, and it did so with the principal purpose of obtaining a tax benefit and/or reducing a foreign tax liability. The next elements relate to the taxpayer. The taxpayer must be a significant global entity. The taxpayer must have an associated foreign entity that is connected with the scheme, and the taxpayer must not be a specified type of widely held investment entity. The final elements relate to certain exclusions to the DPT. Where the taxpayer's income and any DPT tax benefits is up to $25 million, where foreign tax liabilities are deemed to be sufficient, being at least 80% of the reduction in the Australian tax liability, and where the profits reasonably reflect the economic substance and commercial reality of the activities undertaken. However, if the DPT provisions are satisfied, a DPT assessment will be made to the taxpayer, imposing a 40% penalty tax on profits that have been artificially diverted from Australia. The taxpayer has an opportunity to provide further disclosure to the Commissioner to attempt to reduce the DPT assessment. The taxpayer can also amend their income tax return to reflect more appropriate outcomes, which can potentially reduce the DPT to nil, although penalties and interest may still apply to their income tax return lodgement. To recap, Part 4A of the ITAA 36 contains two sets of provisions aimed at limiting multinational tax avoidance. The MAAL provisions capture artificial arrangements that avoid profit attribution to Australian permanent establishments. Any tax benefits may be cancelled, with Australian assessable income increasing to reflect the alternative postulate. The DPT provisions capture artificial arrangements that divert or shift profits from Australia to a low-tax foreign jurisdiction. A tax penalty of 40% may be applied to the tax benefit, although the taxpayer does have options to reduce the DPT through information disclosure and/or amended tax return lodgements.